But look, in summary, folks, it remains a tough market in Wellington. No bones about that. Overall, I would sort of say it like this. We were seeing some quite positive signs of a recovery starting to emerge, or at least positive direction. Market showing signs of turning around in many metrics. Very end of last year, start of this year, the war tipped all that on its head. At least the timing suggests it was the war. My feel is that it's the buyers have just got really scared, and the deep uncertainty. I mean, very different from Ukraine because of the oil impact and the fear around oil prices. What does that mean for inflation? What does that mean for our household budgets getting squeezed? A fear of less discretionary spending, therefore big decisions go on hold. And also, if that drives inflation, what does that mean that the Reserve Bank will have to do with interest rates? Will we see interest rates go higher for longer, and that sort of concern? So we've certainly seen that come through in the numbers in the last 4 months since April. So overall, look, we are again reaching new lows, new low point in value in Wellington since the peak in late 2021. I mean, we've had four consecutive new low points since, being April, May, June, July. Message for sellers is that values are down, listings are down, and sales are down. And the one thing in there that is different from what we've seen kind of recently is that listings are down. Now, as a seller, listings down is great news because it means you have fewer properties, new properties coming to the market that you're competing with. If you are competing for the attention of buyers in the market, you want fewer listings competing with you. So if we're seeing a drop in listings, that is a positive sign for sellers. We typically see seasonally a drop in listing volumes coming to market as we come into winter. We have seen that, but what I'm talking about here is a drop in listings compared to the same time last year. Now, again, typically what we see is as we come into the election, listings tend to be, all other things being equal, there tends to be fewer listings coming to market as we head towards the election because the psychology of sellers is the election is a big uncertain event in the near future. Obviously, it's a bad idea to sell prior to the election when that uncertainty is in the near future. I'll wait till after the election, then I will sell once I know what's happening. The problem is everybody thinks like that, and so as a result, there's far fewer typically listings coming to market as we come into the election, and that makes it, all other things being equal, a better time to sell because there is less competition. After the election, everyone dumps their property on the market. Certainly, that is what happened last time. I'm not saying this time is the same as last time, but typically that's what happens. Vendors freeze up coming into the election, and ironically, that makes it a better time to sell often. So sellers, in order to sell, your presentation has to be great, and issues with the property ideally resolved, and your pricing has to be realistic. Very achievable with those things, but those things are even more critical in a tough market like we're in now than in a normal market. Message for buyers, of course, is wow, have you ever got it good? Yes, you do. You have so much choice and you have wonderful ability to negotiate in this market. So I encourage you to get in amongst it. Okay, let's get into the numbers. Median sale price 725 in July versus 755 July last year. That's a drop of 4%. Look at the shape of that red line. You'll see since late 2021 into 2022 the massive drop. That big drop is clearly behind us. Broadly speaking, we've been going sideways since then. And this is the election. That upswing there, that is heading into the election last time, and then the erosion of values reasonably consistently, very gradually over the last 2.5 years. Um, this here is the little uptick that I mentioned that we were starting to see some positive signs in the market. Very end of last year, first couple of 2 or 3 months of this year, and then look at those blue bar charts there. That's median monthly sale prices. They have tailed off. I don't pay too much attention to the median sale price because not only does it reflect underlying values, but it also reflects the mix of properties sold in the month. So it's not the best guide to underlying values, which is, of course, what we're most interested in as owners and potential sellers. The best guide there, in my opinion, and in the opinion of many others, economists and commentators and so on, is the Real Estate Institute House Price Index. This is the league tables. You can see there that Wellington, this right-hand column shows us the movements since the technical peak in values, which for Wellington was October 2021, 29.2% down, a bigger drop than any other part of the country. That has been the case since the market shifted downwards. But that is the biggest drop. That's the biggest number that we've seen. As I said at the top, we have fallen to a new post peak low. So that's the biggest gap we've seen at 29.2% down. Wellington City, because that's the region, Wellington City is even bigger drop at 31% down. So generally, what we've seen kind of since COVID really is that the cities have been out of favour. Um, Provinces, more lifestyle has been in favour, and the North Island has been out of favour, and the South Island has been in favour. Yeah, big drops in values. Auckland not that far behind at 25% down, but the rest of the country has fallen to a lesser degree. Wellington region, as I'm saying here on the left-hand side, Wellington region values are about back to where they were in August 2020. So that would have been just early in the COVID, post-COVID boom. Wellington city values are about the same level as where they were back in September 2019. So that is almost 7 years ago, and definitely before the big COVID boom. So all of those gains have been unwound and some. And the Wellington City has fallen a little bit further than Wellington region overall. Over a year, again, Wellington region biggest drop compared to the rest of the country. Over the last 3 months, though, it's quite different. You can see there are plenty of regions there that have shown weakness to varying degrees. I mean, Southland there, that's an unusual one because Southland has typically been quite a good performer over the last few years, down 3.8% in the last 3 months. Wellington 3.2%, so not kind of standing out on its own like we have been in the last year and in the last, or since the peak. So at least we've got some company this time. But again, that kind of supports the argument that over the last 3 months, and in fact over the last 4 months, but this is 3 month data that we're looking at in particular here, but over the last 3 or 4 months, the whole country has kind of shifted since the conflict in the Middle East. So, I strongly suspect that that is what has driven that change in the last few months in particular. Frustrating because we were just starting to see us, as I said, in New Zealand, we had started to see some signs of some recovery for some time now, but Wellington, it was slower to emerge. We were just starting to see it, and now it's been unwound. And as you can see there, look, I mean, over the last 3 months to have dropped 4.4% in just 3 months, and I think it's about 6% in the last 4 months. So that's a big drop for 4 months, that's for sure. There it is in the graphical form. So the blue line is monthly movements in the house price index. The orange line is 3 month cumulative. So how much has it moved in the entire 3 months? Obviously, very big drops in 2022 as we came off the boom. We saw some good recovery, as I said before, coming into the election. After the election, big drop off again. Now, so there's the evidence, or some evidence at least, for the smart thing to do being exactly the opposite of what most people think. Everyone knows it's a bad time to sell before the election, but this proves otherwise. And they also know that it's better to wait till after the election to sell. Again, this proves otherwise. So it's like a lot of things in markets. When everyone is zigging, you got to zag. Um, but in particular, and as I said before, you can see there were some reasonable signs. I mean, they weren't smashing it, but there were some tentative signs of reasonably consistent recovery in the right, moving in the right direction there. I mean, it's still negative territory here. It's below zero, but it's moving in the right direction. And then we did step up above zero. And then, but as soon as we were through March, as soon as that conflict was, was in full force, April took a dive, and cumulatively speaking, we took a really big dive in the 3 months to June. A little bit of a recovery here in July. So, is this possibly, early signs of some stability returning? Because, of course, stability would mean that blue line and ultimately the orange line hanging around zero. That would be stable. Above the zero, the x-axis, would be some recovery in values. Below is again erosion. So, is this an early sign of some stability? We shall see. Wellington City, same general shape, just a bit more exaggerated, deeper troughs, higher highs, a bit more erratic, a smaller data set. But look at that drop off in the last 4 months, or the 3 months in particular to June, massive falling off a cliff there. So yeah, Wellington City has suffered the same fate, possibly to a slightly greater degree, and this potential early signs of recovery is not quite back up to zero so far, but it's still the same shape. So, is it possible that we're heading back to recovery? And I've sort of been thinking about the war, and what if the war continues for some time, because it seems to be reasonably persistent so far. Does that mean we will remain in a terrible market that continues to drop away? And I don't think it does mean that, just because that's what we've seen in the last 4 months when the war has been going on. And the main reason, for my logic at least, is that prior to April, the norm was no war in the Middle East, no stranglehold on oil, no major worries about an oil crisis and the resulting inflation and interest rates. Now it is the normal. So we went from no Middle East war, no oil crisis, to war and oil crisis and all of the concerns that come with it. But going from war and oil crisis and all the concerns come with it to war and oil, it's not a change. It's just a continuation of what we've seen for the last 4 months. And so people becoming used to the status quo is far less scary than going from no war to war, if that makes sense. Anyway, that's my logic, and I'll stick with it for the meantime. And there's the graph in terms of the gross numbers. So you can see, look, yes, we were seeing some erosion. There's after the election. There's before the election. Big, quite a significant increase in values, about 10% from here to here. 10% increase in values heading to the last election. And then the whole lot was basically unwound coming out of the election. Some reasonable stability, a little bit of a recovery, as I said, end of last year, start of this year, and then again, erosion in the last 4 months is fairly clearly visible there. Number of new listings, 438 in July versus 507 a year ago, 575 2 years ago. Now, this is one kind of positive data point in the series. As a seller, what you want, if you're looking to sell your property, what you want is fewer listings to compete with, like I've been saying. The red line here shows the kind of longer term trend. That's a 6 month average. Typically, we see between 600 and 800 new listings coming into the market in Wellington. We've been sitting around that sort of that range for a very long time there. Then a massive drop off after we came off the peak, and all the vendors went, "Whoa, no way am I selling with prices falling like that." Then then after the and then that was in, then and then also on strike, vendors on strike as we went into the election, and then after the election, massive flood of listings coming back to the market, and then we've been operating in that normal kind of level again. Um, yeah, but this month, what we're seeing here is a significant drop off in new listings in July compared to last July and 2 Julys ago. So again, that's a positive sign for vendors. And now, is this the first of several months where we're going to see that contraction in new listings coming on, driven by this concern that you shouldn't put your property on the market prior to the election because there's too much uncertainty? Obviously, we shall see. But if we do see that continued for the next few months, then that is potentially a positive thing for sellers, and we might see that with providing some firming, some support to the market, which would be, in my take on things at least, would be welcome. And so new listings down versus last year and the year before, and new listings also below what's average for July. So that's interesting. 16% below what we normally see in a typical July. So again, a positive sign for sellers. And this is looking at it compared to 12 months ago. So above the x-axis means more new listings coming on in the month compared to the same time last year. Below the x-axis means less. So again, as a seller, what you want to see is the red line, the trend going below the x-axis. As a buyer, what you want to see is it going above the x-axis, more stock coming on the market than a year ago. So you can see we were things were looking good for a while. Things were improving throughout 2025, gently, slightly fewer new listings coming to the market on average than the prior year. Then late last year, we saw a little bit of a recovery there, and we've seen new listings falling away again in the last month in particular. There's that blue bar chart there. So could this be the start of a several month long pre-election trend? We shall see. Number of sales, on the other hand, 524 versus 600 a year ago and 592 years ago. So again, this is weakness that we're seeing in the market. So the new listings contracting compared to a year ago or 2 years ago, that indicates strength from a seller's perspective, but lower number of sales, that clearly indicates weakness. So these are two conflicting data points from a seller's perspective. 13% down on a year ago, 11% down on 2 years ago. And again, that red line reasonably clearly shows the trend, quite instructive there. So we were seeing disastrously low levels of sales taking place for a good couple of years in 2022, 2023. Then we saw number of sales gradually increasing, broadly stable in 2025 at what I would call the very bottom of the range of what would be considered to be a normal range. So in a normal market, 600, 610, 620 in a month on average is really low. But it's not low compared to where we were here, which was, into the late fours, mid to late 400s on average in time. So that's disastrously low. And then in the last 8 months or so, very gradual eroding of the number of sales taking place. So that's slow creeping weakness back into the market there. And compared to what we typically see in July, again, fewer sales than we typically see in July. So low new listing volumes, but also low numbers of sales. And there it is compared to 12 months ago again. So again, that trend is very, very clear. We were seeing market improving, more sales taking place, but then recently that trend has gone back down below the x-axis again, which is indicating weakness for sellers. How long is it taking to sell? In broad sense, a long time. So 55 days in July versus 53 a year ago, 46 2 years ago, and compared to an average of 41, which is typical for July. So 55 days, 14 days longer than what we typically see in a July. Again, that red line shows you the trend very, very clear there. For the last 3 years, ironically, again, as we headed into the election, the days to sell dropped off a cliff. as the amount of supply coming on really contracted, which again, as I keep saying, made it a good time to sell. And then after the election, since then, it's basically been getting longer and longer and longer. Inventory, this is the number of weeks of supply we've got on the market. How long would it take to clear what's on the market today if things continue to sell at the same pace? Again, from a seller's perspective, a large amount of inventory is not good. From a buyer's perspective, that is good. And again, that trend is clear, and you can see again the trend before and after the election. Some stability, and then in the last 4 months or so, 5 months, weakness returning back into the market and the inventory stretching out a bit. Long-term average is 15 weeks, so a bit longer than that, but over the last 11 years, the average has been just under 11 weeks. So at 17.8 weeks in July, it is 63% more inventory than we typically see in July, at least since 2015. So a lot of inventory. Same story, consistent theme. Trade me listings. Um, Again, you look at the blue bar chart, that shows you that we've been coming off. That looks like a good thing, but it's just seasonal. As we come out of summer and into winter, the number of new listings drops again because people think winter's a bad time to sell. Trade me data, again, what might seem ironically, supports actually that winter's a good time to sell, but that's because of this reason. People think it's a bad time to sell, therefore there's less competition, easier to get the attention of buyers. And but that drop off is seasonal. The red line shows you the average over the last 6 months, which has been continuing to increase. So we're 8% more listings than this time last year, 10% more than this time 2 years ago. So not massive increases, but nonetheless more supply than a year ago, more supply than 2 years ago. And in fact, for this time of the year, August, more supply on Trade Me than we have seen for at least 11 Augusts. So yeah, we have an abundance of supply on the market for this time of the year. There it is again compared to 12 months ago. So as you can see there, throughout 2024, we were seeing significantly more supply than 12 months prior. We were heading back to parity, but over the last few months, that gap, that surplus has kind of widened again. The surplus compared to last year is starting to open up again. So again, that's not great news for sellers, good news for buyers. So in summary, folks, values have been declining in the last 4 months, especially a sharp decline basically since the conflict in the Middle East. 31% below peak we are now at in Wellington City, and just over 29% down from peak in Wellington region. New listing volumes are down. That is a positive thing for sellers, 16% below what we normally see in the month of July. Sales volumes also weak, however, so that's not good news for sellers. 13% down compared to July last year. Selling times remain long, 55 days versus July average of 41. Inventory remains quite elevated, well above historical norms. We see over the last 11 years an average of just under 11 weeks. We are just under 18 weeks worth of inventory. Trade Me Lockers stock is high. In fact, we are at we got more stock in August than we've seen in at least 11 years for this time of the year. So the message to sellers is really clear. The market remains pretty weak. It's hard work, but you definitely can sell. But pricing and presentation are absolutely critical. Buyers, you have an absolute the best of conditions out there. You've got amazing choice, an incredible opportunity to negotiate hard and get fantastic value. So obviously those are two different stories, but two sides of the same coin. So thanks, of course, to Real Estate Institute and realestate.co.nz, where I get the data from. Thanks to you for checking in. But an opportunity for questions. I can see there's a question in the chat. What has that got there? Do you think the Wellington City Council rates and Chiaki Y has had a big impact on property in Wellington? I think that council woes in general have had like more like a longer term dampening contribution to Wellington, to the overall Wellington story. But there are multiple inputs here. So put it this way, rates continuing to go up at 10% per annum. I mean, my rates at home, I haven't looked at it for my investment properties, or I haven't done the comparison, but my rates at home, when I take the rates and the JACUI bills, they're about 10% higher than what I was paying in rates last year. So rates of that level of increase for multiple years in a row, that is literally impossible for that to support the real estate market, isn't it? So it is a dampening effect, but I don't think it's the big force that is at play here. There are multiple other things. We had interest rates, we had loss of jobs, we had prices that were just too high, we had immigration fall off a cliff. There is many factors feeding into this whole process. So there's no question that rates and water rates included increasing does not help the real estate market, but I don't think it has been the big story or the big factor that's driving it, Brenda. Yeah, but thanks for your question, and hopefully that answers it. That's my opinion anyway. Any questions for anyone else? Just unmute yourself and jump in. Happy to chat. We might be done. All good. So if you do want to have a chat offline, then by all means reach out. If you want individualized advice, happy to help. You know where to find me, Adam at Lunco. But otherwise, thanks. Take care. Have a great week. Have a great month, and stay warm out there. See you. Bye bye.